Hi everybody, this is Lara at pureelliottwave.com. This is a different video for you this week. I'm going to try and answer in a fair amount of depth a question that a member recently posed to me a few days ago in reference to the S&P 500, but it also applies to other markets. My member says the most difficult thing for me is to find the good look, I think he means the right look, in each degree, and to respect the duration of each cycle. You say that the wave cycle 5 can last from 1 to several years. So far, it's on its 23rd month. Normally, we should expect a wave of cycle 5 and cycle 1 to be of the same intensity and duration. So a few months later we're there, but you say that the wave of cycle will end in 1929. This is my concern, and I find the same errors at very lower levels. I think he means issues, not really errors. The first thing to note in this question is expecting cycle 5 and cycle 1 to be of the same intensity and duration is a guideline, not a rule. And when we look back at the price history of the S&P and other markets, they are most commonly about even in length, and they may most commonly be of about the same intensity, but they don't always reach equality and they don't always look the same. That's a guideline, not a rule. The other problem here, and this actually took me a while to really wrap my head around, is that a lot of markets, the S&P and 500 in particular, has a really strong bullish bias. And that strong bullish bias means we have to approach how long we expect each wave to last with quite a great deal of flexibility. This is my wave notation that you can download from the footer of my website. It's a PDF form and it's free to download. And it outlines the different notations that I use on all of my charts. It'll help you read my charts. And it tells us how long we would normally expect different degrees to last. The most important degrees are cycle, primary, intermediate and minor. We can normally expect cycle degree waves to last from 1 to several years. Primary degree waves will normally last a few months to a couple of years. Intermediate degree waves should normally last weeks to months, and minor degree waves normally would be expected to last weeks. I'm going to go over some charts of the S&P 500, and then I'll also go over Bitcoin for you, and I'll show you that if a market has a strong bias in one direction, for those two it's bullish, then you can expect that you're going to have to be really flexible with these durations. Let's start with the S&P 500, and let's start with the really big picture. This is my grand supercycle degree analysis for the S&P 500. I have supercycle wave 1 ending at that peak in October 1929. There was that massive dramatic stock market crash leading to the low, the trough, in 1933. 1929 I've got starting off the left of the chart, which is before I have data. There is amalgamated data for the US markets that goes back prior to this, but I haven't been able to find it in a reasonable format that I can use for my analysis. So I know that supercycle wave 1 has lasted well over 50 years. Supercycle 2, though, was over in just 4 years. Let's go back to how long we would expect that to last. We'd expect it to be multi-decades. But when you look at the S&P 500, it's only lasted 4 years, and you cannot find another correction in this chart that has lasted multi-decades. But you can find a bullish movement that has lasted multi-decades. The corrections for this market are much quicker than the impulses or the bullish movements that they correct. And then I have supercycle wave 3 ending in the year 2000. This is the end of the dot-com bubble when that burst, and here's the dot-com crash. Supercycle wave 3 I have lasting 67 years. Yes, that is multiple decades. That is what you would expect for a supercycle degree wave. But then we have supercycle 4. It's a flat correction, and it ended in March 2009. It's lasted just 9 years, not even 1 decade. There is no other correction following supercycle 3 that is lasting multiple decades. The corrections are much more brief than the impulses that they're correcting, because this market, as you can see very clearly from this chart, has a very strong bullish bias. And the other thing you can see about supercycle wave 3 is it's got a short cycle 1, cycle 2 corrects it, an extended third wave in cycle 3, a brief cycle 4 that corrects it, and another extended wave in cycle 5. Waves 1 and 5 do have a tendency to equality, but they're not always equal in length and duration. Here, both the third and the fifth wave are long extensions. You see that especially in cryptocurrencies, and here we see it in the S&P 500. So we can't always expect waves 1 and 5 to be equal in length and duration, because you can have one or two of waves 1, 3 and 5 extended, just not all three. Cycle wave 5, or sorry, super cycle wave 5, I have so far as incomplete. Let's go down to a monthly chart level, and we're going to have a look at this wave up here. We're going to look at the subdivisions within this fifth wave. I have super cycle 3 beginning here, labelled cycle 1, 2, 3, 4, 5, and you can note that the corrections here of 4 and 2 are much more brief than the impulses that they're correcting. That is the reality of the data, so we have to be really flexible with how long we would expect those degrees to last. Let's take a look at the S&P at the monthly chart level. So this low down here, the end I have of cycle 4 within super cycle 3 is this low down here. So now we're looking at cycle wave 5 within super cycle 3. Remember, this is the high in March 2000, the end of the dot-com bubble. Cycle wave 4 down here is the low in October 1987. This is the 1987 stock market crash, and I'm labelling that a cycle degree fourth wave. Within cycle wave 5, let's look at primary degree waves, and this is on the monthly chart. So we've got primary wave 1 lasting 32 months. Primary wave 2 that corrects it is a bare 2 months. But within this impulse here, you'll note that you really wouldn't want to put primary wave 2 anywhere else. This is where it fits. It's a fairly good correction of primary wave 1. And then you've got primary wave 3 as a long extension. It's lasted 93 months. That's 7 years. That's more akin to a cycle degree wavelength. But it's lasted a very long time because it's a very long extension. When waves extend, they do so in price and time. We have to be pretty flexible with those guidelines of how long those degrees should last. Then we've got primary wave 5, which has lasted just 17 months over at this high up here. So primary wave 1 is longer lasting. It's 153 points in length. Primary wave 5 is much stronger, but it's more brief. It's 17 months, and it's 629.55 points in length. Primary wave 5 is quicker, but stronger than primary wave 1. It exhibits greater intensity. Overall, it looks like primary waves 1 and 5 are kind of similar on a semi-log scale, but when you look at the actual distance travelled, it's quite different. So you have to be really flexible with how long those degrees last. Let's look at the daily chart level. Let's have a look at the middle of this extended third wave. Here's the middle of the extended third wave. We're looking at an intermediate 3 within primary 3, within that cycle degree fifth wave. Third waves, particularly for this market, are most commonly extended. Here we've got minor wave 1 lasting 104 days, minor wave 2 over in just 70 days. This is a daily chart now. So minor wave 1 has lasted 20 weeks. That's quite long for a minor degree wave, but minor 2 is over in 14 weeks. That's about right for a minor degree wave. Minor wave 3 lasted 203 days, so that lasted 40 weeks. It's a long extension compared to minor wave 1, and it's extended in price and time. Minor wave 4 that corrects it, though, is over in just 7 days, 1 week. That's acceptable for a minor degree wave, particularly a correction. Minor wave 3 at 40 weeks really is pushing the extremes of how long a minor degree wave should last according to those guidelines, but you have to be really flexible with a market like this with a strong bullish bias. And now minor wave 5 is over in 87 days. Here it's interesting that minor wave 5 again over in 87 days, which is 17 weeks, totally acceptable for a minor degree wave, is shorter in duration than minor wave 1, which is 104 days, but minor wave 5 travels more than twice the distance. It's 92 points in length, whereas minor wave 1 is 41 points in length. But when you put them on a semi-log scale, they do look more even in terms of distance travelled, but you have to view a longer term picture on a semi-log scale. You have to approach the duration of these wave degrees with a good deal of flexibility, particularly for the S&P with a strong bullish bias. Don't expect the corrections to be as long lasting as the bullish movements that they correct. Let's have a look at the price history of Bitcoin for its first wave. This is from the low down here. We've got 2010, and this high up here is the end of what I have as cycle 1, which is December 2017. That high just under 20,000. From this low to this high, this upward movement for Bitcoin subdivides as an absolutely perfect 5-wave impulse. It's got a strong bullish bias. This cycle degree first wave, this is on a monthly chart, this has lasted 86 months. So that's just over 7 years, which is absolutely what you would expect for a cycle degree wave, from 1 to several years. So 7 years is perfect. Notice though that cycle wave 2, correcting it, has lasted just 12 months, only 1 year. So we've got a bullish wave lasting 7 years. The wave that corrects it lasted just 1 year. The corrections are much more brief than the bullish move that they correct. And you'll notice that also within cycle wave 1. Here you've got primary 1 lasting 8 months, and primary 2 is over in just 5 months. Primary 3 is an extension. It's lasted 24 months, so it's longer in duration and price than primary wave 1. Primary wave 4 was a triangle, very time consuming, lasting 21 months, still more brief than primary 3. The sharpest, deepest part of primary 4 was over in just 3 months. And then we have primary wave 5, which has lasted 28 months. So the impulses of 1, 3 and 5 are more long lasting and travel a greater distance than the corrections that correct them, with the exception of the 4th wave triangle. The sharpest corrective part of it though was really quick, just 3 months. This market also has a strong bullish bias. It also has very, very deep corrections, but over its price history so far, it has shown, like the S&P, to have a very strong bullish bias. So when markets exhibit that bias, we have to be really flexible in how long those different wave degrees should last. I hope that makes sense. I hope I've used this price history of these two markets to illustrate to you why we need to approach these wave degrees with quite a great deal of flexibility. I always start with a monthly chart and as much data as I can find, and I try and get the cycle degree waves, the impulses particularly, I try and get them fitting in terms of duration, and then I move down to lower levels. And when I'm looking at extended waves within lower levels, I'm going to allow much more flexibility in terms of duration for these different waves. So let's now come back to the S&P and try and answer this member's question finally. So my member's concern here is that cycle wave 1 has lasted 26 months, cycle 2, 5 months, cycle 3 has lasted 83 months, cycle 4 just 18, and cycle 5 I'm not labelling it over here. There's a bunch of technical reasons why I'm not going to label cycle 5 of super cycle 5 of grand super cycle 1 over at this high. Basically technical reasons, not Elliott Wave, because yes, Elliott Wave would fit. If we saw it over here, it'd be just 22 months. And this here was 26 months. So the proportions would look really good. But I am expecting cycle 5 may be extended, like cycle 3 was. 1 or 2 of waves 1, 3 and 5 may be extended. While 1 and 5 do have a tendency to equality, they are not always equal in length and duration. And in this instance, for a bunch of technical reasons, I'm expecting cycle 5 to be more akin to cycle 3. And that's okay. Sometimes the S&P does that. When it's all over, I expect cycle 5 might be more akin to cycle 3 in terms of look on a monthly chart. I hope that answered your question, and I hope, because this is a common question, a lot of people ask quite regularly, I hope that's answered a few other people's questions as well. Thank you so much for watching, and thank you for all your support on the YouTube channel. I really do appreciate your engagement.